Hello and welcome. My name is Trent Cripps and I'm the Director of Property at Your Future Strategy. Hope you're keeping safe and well during these challenging times.
Well, it certainly has been an eventful start to 2020, with the summer bringing some of the worst bushfires that we've seen in Australian history, followed by some of the wettest months that's seen since 1924. And then, of course, on January the 25th, our first positive test for COVID-19 in Australia was recorded, which then obviously resulted in March, Australia closing borders to visitors and residents. And on the 28th of March, Australia reached the peak of the COVID-19 positive cases. And in the last couple of weeks, we've also been able to see the easing of restrictions in several states, which will continue to roll out over the coming weeks and months. Let's hope moving forward for the rest of 2020, there are more positive things to look forward to. Today, I'd like to talk to you about the effect that COVID-19 is having on the Australian property market. According to the recent CoreLogic Home Value Index results, housing values in Australia have not seen any evidence of a material decline in April, despite a sharp drop in market activity and a severe weakening in consumer sentiment. So far, the COVID-19 downturn has had a dramatic impact on agent activity and listings volumes in residential real estate, but the value of dwellings has been relatively resilient. This chart shows the rolling 28-day change in the daily CoreLogic Dwelling Value Index for the combined capital cities markets. In the 28 days ending May the 4th, the change in value has reached 0%. So although values have dropped slightly in this period, it has only been on average just over 1%. It is likely that property values will fall further amid the downturn. But the decline in momentum across property values has been mild relative to what has happened in market activity. Looking at this chart for the 3 months to April, growth in dwelling values nationally have slipped to 2.1%, showing that even during the COVID-19 pandemic, we can still see positive growth in values for the 2020 year to date, with all major capitals still in positive territory. However, a positive start to the year amid such challenging events that I highlighted earlier in this video, some of these gains have been eroded by the current pandemic. It seems hard to digest that property values have not plummeted when you think what we have been through so far this year. In an address given on the 21st of April, Reserve Bank Governor Philip Lowe outlined that we are facing the worst economic contraction since the 1930s. Lowe suggested that by June 2020, we will see national economic output was likely to be falling by 10%, total hours worked would fall by around 20%, and the unemployment rate could reach 10%. With large losses in jobs and hours worked, the same level of income is not available to service high housing debt. This would presumably mean more people having to sell property or a larger volume of distressed sales. And yet, to date, there's been no evidence of that. So how is our property market so resilient? Well, there are a number of reasons our property market is holding up so well during these challenging times. Listing volumes, rather than an influx of supply to the market, are very low. In the 28 days ending 3rd of May, new listings volumes were 28.7% lower than they were in the same period last year. In this slide, we see the total listing stock of dwellings for sale in the same measurement period were down 23.8%. The fact that listing volumes and seller activity is so low, and therefore available housing supply constrained, may be one factor preserving relative stability in property prices. Another related factor may be vendor expectations. The fact that this is a temporary enforced downturn means that vendors might be holding on to a relatively high expectation of their property value, with a view to sell once the economy returns to full scale. I am currently searching for property for a number of clients at present, and I am seeing very little to no drop in price expectations from sellers. Another factor would be the banks stepping up to support with the option for customers to pause mortgage repayments, which is another key factor for the stability of property values. This allows people to have a mortgage holiday should they need it if they have been financially impacted by the coronavirus. The government's $17.6 billion economic plan to keep Australians in jobs, keep businesses in business, and support households and the Australian economy as the world deals with significant challenges posed by the spread of coronavirus is another significant contributing factor. All these factors mean the only people listing their property in the current market may be those wanting to sell and test the market with the low volumes and consequently not reducing their price expectation. And those who need to sell because paying off a mortgage is no longer affordable or due to unfortunate events such as divorcee or deceased estate sales, and may be open to a larger than normal reduction in price, which at this stage seem to be low in numbers. A true test for property values may come once these holiday periods end. Financial regulators, the RBA and the banking sector may extend reprieve for mortgage repayments in the scenario that the economy has not made improvements within the 6 months. So what's next for property in Australia? It's understandable that many Australians expect the property markets to behave like they did during previous economic downturns, such as the global financial crisis in 2008. We have not seen a contraction like this and will be unlike anything we have seen since World War II. We know that demand for property historically increases when international stock markets fall and our dollar weakens in response to global financial instability. However, unlike previous downturns that were essentially financially led, this downturn is a medical problem that has morphed into an economic issue because of a short-term shutdown of our economy. It is predicted that the crisis will be relatively short-lived, unlike the effects of the GFC, due to being a health crisis and not a credit crisis. That is very different from a recession preceded by economic excess and speculation. In 2021, upon delivery of a widely anticipated vaccine, it's expected that most countries will return to what will be our new normal. People will once again be able to travel, jobs will rebound across many sectors, infrastructure will be fast-tracked, and we'll see positive improvement in property values, particularly in property with land value attached. As you can see from this chart, this has been the case for every crisis and cycle that has existed prior to this one for over 100 years. History has shown that even through global crises such as the GFC, 1991 recession, 87 stock market crash, and outbreaks of illnesses such as SARS, the Australian property market remained resilient. In fact, during the SARS outbreak, we saw markets like Brisbane and Perth increase in value due to their affordability compared to the Sydney and Melbourne markets. Is history about to repeat itself? So, what can we expect in relation to property over the next 3 years? As none of us have a crystal ball, I feel this will become more apparent depending on how long before lockdowns are lifted, we have a COVID-19 vaccine, and the world can open up and be connected again. Historic level of government stimulus and bank support packages available, our residential property market will hold up reasonably well for the next 6 months. I expect real estate new listings and transactions to remain low, but don't expect there to be a significant drop in property values across the board. My prediction over the next 3 months, I would project A grade and investment grade properties or above average homes could fall in value upwards of 5%. B grade or average homes could fall in value by up to 10%. But this will be on low levels of transactions, and the pace of recovery from that point will depend on the state of the wider economy. Overall, I expect residential property will be in relative hibernation over the next 3 months. With a government-mandated freeze on evictions and mortgagee sales for the next 6 months, along with freezing of, there will be limited external pressure regardless of an individual's personal situation around their employment. This will avoid forced sales on any scale that would impact the residential property market over the next 12 months. In a statement from the RBA, Australia's financial system is resilient and well placed to deal with the effects of coronavirus. The banking system is well capitalised and is in a strong liquidity position. Substantial financial buffers are available to be drawn down if required to support the economy. I believe that suppressed transaction activity means we can expect to see a build-up of latent demand and the markets will start to rebound perhaps as early as the second half of the year. Expect that suburbs with high levels of rental housing will be most impacted, where prospective tenants have lots of options, areas with high concentration of similar apartments, areas that have short-term let properties, such as Airbnb properties, converting to long-term rentals, pushing up vacancy rates. Properties near universities that were reliant on overseas students as tenants that simply aren't there at the moment. I expect house and land to perform better than off-the-plan apartments. There may be some risk to buyers who have bought off-the-plan apartments. When it comes time to settlement, there may be some low valuation concerns and the buyer's ability to get finance as a result. This may stifle the apartment market for an extended time. Housing shortages to continue as developers put project starts on hold during COVID-19 crisis, further reducing supply of new dwellings required. In 2021, post the COVID-19 pandemic, I expect a strong and sharp rebound of property values in Australia and pick up on where we left off in early 2020 as more normal market conditions re-emerge. One trend likely to emerge is to be the increased demand in areas outside major CBDs, particularly coastal areas with reasonable proximity to a CBD, as a result of workers realising the viability of working from home and also retirees keen to escape heavily populated areas. What about the forecast for interest rates? Well, according to AMP Chief Economist Dr. Shane Oliver, the cash rate is as low as it's going to go, and the next move for rates will be up, but it's at least 3 years away, and possibly more. This will give home buyers and investors confidence that interest rates may remain low for an extended period of time, allowing them to make progress with their mortgages. The short-term future of our economy and our property markets will also depend a lot on consumer confidence. So the rise in consumer confidence reported by Roy Morgan and ANZ just recently is encouraging. I guess more of us are seeing a light at the end of the tunnel. The gain over the past week is predominantly attributable to some easing of COVID-19 restrictions and optimism surrounding the daily new cases figure. There is still a way to go before sentiment gets to levels where people can be said to be optimistic, however. I hope this has given you some insight as to how property's been performing during the COVID-19 crisis. As you can see from my presentation, I think property's been pretty resilient right throughout this last few months of challenging times. I think the underlying fundamentals are very positive and strong for growth over the coming years as we come out of this current pandemic that we're experiencing at the moment. The key to navigate your way through this current crisis is to have a sound strategy and understand the importance of taking a long-term perspective of your property investing, not to get caught up in the hype and the fear and make some rational short-term decisions. If you're in the position to, now is certainly a great time to take advantage of opportunities in the market. It's in times like these where some significant wealth can be made should you have the right strategy. Should you wish to chat about your personal circumstances and your position and how you can possibly move forward through, I'm happy to talk to you about how you're going with your property portfolio and your investing and answer any questions that you may have around the market. Please feel free to get in contact with me. Of course, we have a disclaimer at the end. The information and material provided in this presentation is for general information purposes only. It shouldn't be used as a substitute for professional advice and is not intended to be part of your strategy. Should you have any further questions, please feel free to get in contact with us. Well, that concludes today's presentation. Thank you for your time and listening. Please look after yourselves, stay safe and well, and look forward to talking to you again soon.